hold your horses. Am I seeing this correctly? This could be more ridiculous than my Christmas suit in the beginning of November. Mike Tyndall has a 47% success rating, rating stocks with an average return of negative 1.3%. And his report on Tesla, which was granted mostly bullish on Tesla, caused Tesla to fall over 6% today. Is there something bigger at play here, like a lot of you suggest down below in the comment section of the last video? Well, we're going to get into that. And this is pretty surprising. At least I was surprised. That is not the only thing that is surprising. Fed Jerome Powell dropped an F-bombshell on us today. Yes, he said the F word on live television. You seen the real Jerome Powell today. And we're going to share that and exactly what he said about Fed policy. We also have Nick Timmerhouse putting his opinions on what Fed Jerome Powell said today. We do have economic data coming out tomorrow. The option activity for the entirety of the day today. I want to take a look at that around Tesla stock, and also some news that is coming out here in after hours. So we have a lot to get into in a very short amount of time. Hit that like button as well as subscribe to the channel and source your comments, questions, or concerns down below in the comment section. Let me know what you guys think about all of this information. Let's start with what the Fed said today. And first things first, Jerome Powell said close the effing door. I posted all of these updates to the X account, but take a listen. It seems like Meet Kevin already bleeped it out, and it's very hard to find Fed Jerome Powell actually saying this. Financial media does not want you to hear this, but take a listen.
Just close the door. Close the door. Just close the door.
What? Oh my gosh, that is insane, but it really didn't move the markets. They cut the mic as soon as he said that. The other statements that he made today did in fact move the markets. Fed Powell says they will not hesitate to tighten more if appropriate. He then says they are not confident that they've reached a stance to hit 2% inflation. Powell also says they will continue to move carefully. Jerome Powell says inflation has given us a few head fakes, and the process of getting inflation to 2% has, quote, a long way to go. So these comments from Fed Jerome Powell caused stocks to slide pretty consistently throughout the rest of the day. But what actually started this was a 30-year bond auction. I think it's no surprise what Powell said was very much anticipated by humans. This took me by 0% surprise. The algorithms, on the other hand, are programmed to sell stock when Fed Jerome Powell uses these words. So it looks like Powell, in my opinion, well, doesn't exactly want the rally to continue. But again, if this 30-year bond auction had not done this, literally these big candles were the bond auction, maybe Powell would have been received a little differently. You were already bearish heading into Powell, and we really didn't get new information. It was kind of the same old, same old. And that's pretty much what Nick Timmerhouse said today. He says the Fed funds rate is around 5.3%. And if expected 1 year ahead inflation is around 3%, that implies a real rate above 2%. He says that's well above mainstream estimates of the neutral rate. And policy is probably significantly restrictive, quoting Fed Jerome Powell. So if that doesn't make sense to you, basically your Fed funds rate minus 1 year ahead inflation is roughly your restrictive rate, right? If inflation was 3%, Fed funds rate is 3%. In theory, the Fed would neither be accommodating the economy or being a drag on the economy, is the running theory. Obviously, who knows? The science isn't perfect, but that's the theory. So Nick Timmerhouse is basically saying here, the Fed is not going to raise rates again. You would need to see something very bad to get the Fed to actually raise rates, like a way hotter economy than we're seeing now. You'd have to get a super hot couple jobs reports and a couple hot inflation reports. If I can read through the lines of what Nick T is saying as well, he's probably implying Fed Jerome Powell is just sounding hawkish to make sure inflation expectations stay anchored. They've started to rise recently. The data we get tomorrow is going to be very important. You get inflation expectations. And that's what this was about today. It's not about raising rates again. It's about saying we will raise rates again so the markets don't run away with their inflation expectations. Now let's go ahead and get into what I think all of you guys are waiting for. This HSBC situation today caused Tesla stock to drop about 6%, but it might not be exactly what you think. It's actually remarkable how many comments I got in the last video that HSBC is just trying to come out with this report and hit Tesla stock so they can acquire a position in Tesla. Because like I said in the beginning of this video, Mike Teinball is a 2-star rated analyst. He is ranked 5,574 out of 8,601 Wall Street analysts with a success rate of 47% and an average return of negative 1.3%. This guy's opinion caused Tesla stock to drop 6%? Are you kidding me? Even Gary Black is questioning this analysis. He says, quote, new Tesla research initiated by HSBC with the equivalent of a sell rating is getting blamed for Tesla's negative 5% decline today. Most bearish part is his $146 price target, of which 40% comes from FSD, Dojo, and Optimus, which leaves just $90 per share in value for the traditional EV business. For reference, we put $300 in value on the EV business based on a 2030 EPS of $22, a 30x PE, and 13.1% cost of equity. Analyst Michael Teinball says his valuation is 50% DCF, discounted cash flow, 50% based on global tech multiples. Without seeing his analysis, we can't poke holes in it, but our bet is analyst Teinball is assigning a multiple based on the tech category rather than his projected growth rate. If so, that isn't consistent with financial theory. We'll try to get a copy of the full report. He's basically saying if Mike Teinball is valuating Tesla the way I think he is, it's not even the right way to value the company according to financial theory, which is, again, looking at the long term of a company and valuing it on the long term, not just, what could be today, essentially. So I wanted to dig into this a little bit more. Could this potentially be just a essentially fake report to push Tesla stock lower so HSBC can get into a position? Now, we're going to go over some information here. This is speculation on our parts. Who knows? We need to see the full research, and I'm sure we won't get it because it probably makes zero sense. But we're going to just go with it for a second. Now, the first thing I want to point out is Tesla stock has been in a vulnerable position as of lately. It's been in a bullish position as of lately, but still vulnerable. This 200-day moving average is this teal line. 200-day moving averages are by far the most important moving averages. It's where a lot of people base their buys and sells. A lot of stop losses kick in. A lot of your algorithms trade around your 200-day moving average. What you've seen over the prior 4 days was basically every single day, Tesla stock would fall big time early in the day, mid part of the day, and then retrace back to close above the 200-day moving average. This happened 4 days in a row. So you were getting a lot of demand coming in at this 200-day moving average, but you were not getting enough demand to rally the stock further. I thought that was going to happen since your intraday lows were getting lower every day for, the last 3 days before today. So it looked like you were heading for a breakout to the upside. Well, if you break under that 200-day moving average, those breakdowns can be pretty aggressive. So if we were to theorize here, today would have been the perfect day to let out a false report on Tesla, or just a report that really has no merit that makes 0 sense. To the question, does HSBC currently have a position in Tesla? They do not. 0 position. No shares, no calls, no puts, nothing. This I find fascinating because there's something called alpha, there's something called beta. I know you guys have heard this before. Tesla tends to have like a 2 beta. So if stocks fall 1%, Tesla tends to fall 2% or more. Same thing to the upside. If markets tend to be up 1%, Tesla tends to be up 2% or even more, depending on, what's going on that day, why stocks are going higher. You get the point. It tends to move more than the markets. Now, banks, institutional investors, hedge funds, they need to somewhat align their portfolios with the beta of the markets. Meaning, if Apple is 11% of the NASDAQ, well, you need to own some Apple. If you don't own Apple, you have to make it up in like a Microsoft, right? If Microsoft's 9% of the NASDAQ, in theory, you might need to own, 18% of your portfolio in Microsoft to make up the beta in the Apple. Simplest way to put it, and the easiest way I've always thought about it, is if you are a hedge fund, institution, or a bank, you cannot have a year like 2023, if you're just in random stocks, you're negative on the year. Your equal weight is negative for 2023. Whereas your NASDAQ 100, your triple Qs are up 15%. You will lose clients if you do not at least correlate the markets. Your alpha is where you try to shoot for your exponential returns. Like if the NASDAQ's up 15%, if you have alpha stocks like a Palantir or something that is lower weighting in the indexes that can really outperform, that's where you can get like a 20% return for any given year. But you don't want to deviate from the beta of the markets, especially if you're a big money investor, unless your firm just specializes in that. Like an ARK Invest, they have no business being weighted to the markets because investors are not investing in ARK to be weighted to the markets. They're investing in ARK because the next 5 to 10 years should be much better than the markets. But it's not guaranteed to happen this year or next year or the year after that. Long story short, if you are a bank investing clients' money, you at this point, you have to have some kind of exposure to Tesla. Or you have to be really overweight in other stocks that have a high weighting in the NASDAQ or the S&P. HSBC is the largest bank in Europe. They're kind of like the Goldman Sachs of Europe, investment bank. They do a lot of investment banking, but they also do a lot of like client banking as well. So kind of like a JP Morgan, Goldman Sachs had a baby. They actually have assets under management of 2.953 trillion US dollars as of December 2021. So it's not a small bank by any means. It's actually quite a large institution. HSBC is actually the 8th largest bank in the world by assets under management and the 7th largest bank in the world by US market cap. HSBC has more assets under management than Citigroup, than Wells Fargo, than Barclays, than UBS, than the Royal Bank of Canada, Goldman Sachs, Deutsche Bank, Morgan Stanley, a lot of credible, well-known US banks. And they don't have a single position in Tesla, none at all, and it's 5% weighting in the NASDAQ and close to that in the S&P. That really makes you scratch your head and look at this situation a little bit differently. Then I was just curious at that point if HSBC owns any stocks, because if you don't own Tesla, then do you own anything? And yeah, they do. They definitely do. As of August 11th, HSBC owns about 28 million shares of Apple, about 10%. Well, you can't see their portfolio allocation, but they've increased this by about 10%. It looks like a total value of about $5.45 billion. So they do own stocks, just none in Tesla yet. So if I were to give my opinion, which my 2 cents is my 2 cents, you have your 2 cents, let me know it down below in the comment section. One of two things happened here. Either HSBC did put out this false report to push down Tesla stock at a very vulnerable moment, which doesn't look all too unplausible. Or second, they're valuing Tesla in, like Gary Black says, the total wrong way to do it. This report, keep in mind, takes into consideration FSD, Dojo, supercomputers, the robo-taxi, robots. This is not like a 12-month price target necessarily. This is incorporating all the other potentials for Tesla. And the report itself was actually pretty dang positive. Like, we went over that in the last video. It was pretty positive. Besides the valuation of Tesla. This new drone footage put out today looks like a capturing of the Cybertruck doing a power test at the Texas Fremont test track. Tesla is apparently taking steps to begin operations in Chile, a country with the world's biggest reserves of lithium. The company registered Tesla Chile SPA, according to a post on Chile's official Gazette. Joe Biden said while speaking to the UAW members today that 80% of EVs on the road today were built in America. He failed to mention the vast majority of that 80% comes from Tesla, which is non-union. Biden added, unions are more popular today than in decades, but the UAW membership is 70% less since 1970. Elon Musk said on Lex Friedman's podcast today about FSD, quote, the car will be able to drive better than a human ever with hardware 3 and 100 watts of power. If we really optimize, it can probably be less than 50 watts. Here are the US states, the top US states for EV market share, California being number 1 at 25%, District of Columbia at 19.4%, Washington at 17.1%, Oregon at 14.5%, and Nevada at 12.7%. Your lowest ranking states are all in between 1.2% and 1.8%, including Wyoming, Oklahoma, West Virginia, Mississippi, and North Dakota. Tesla's option activity today was 16% positive. Some people think when the positive order value is low, that is actually a good sign. That is not true. As more people take on short positions in Tesla, you have to see market makers buy more puts in Tesla. And that's the best way to think about it. Same thing to the opposite side. When more people buy stock, the market makers most of the time are the ones that are selling you that stock. So if more people are buying shares, market makers have to go out and buy more calls to protect themselves. Options are simply a form of insurance. Today, you had 949 hedge fund and institutional orders worth $1.66 billion, and again, a positive order value of 16%. But let's take a look at what retail is doing. It's actually a different story today. On the call side, 59.05% were calls for the total volume today. 40.95% was put volume. So what? 9% more call volume today on the call side than puts. Retail is actually pretty bullish. And as I did as well in the video earlier today, I bought more shares of Tesla today. And I think retail is not going to squander that opportunity the same way hedge funds and institutions will. But again, that is a very forward-looking statement. I plan to own my shares of Tesla until Tesla hits a 10 trillion plus market cap, which I think is feasible. If you do not, well, contact a financial advisor. If you're wanting more information on anything that's said in this video, take this video to your financial advisor and get their opinion. I am not one, and I cannot give you personalized financial advice, so come to your own conclusions and do your own research, ultimately. If you guys are not following my X account, go ahead and give it a follow. It is Michael Tyler. We like to share things that can hopefully help you make money. This is an interesting one that I reshared today. It says Tesla short interest is $18.63 billion. the world's largest short. 83.84 million shares shorted, 3.03% short interest of free float. Over the last 30 days, we've seen 242,000 shares sold short, worth 53.7 million, a 0.3% increase in total shares shorted as its stock price fell 14.72%. Shorts are down 1.76 billion in November, mark-to-market losses, negative 9.89%. So even though Tesla has been falling as of recently, shorts are still down big time for 2023. And I think that's only going to get worse or exponentially worse for shorts in 2024. Now, tomorrow, what is going to dictate how the markets trade is likely going to be your yields. Your yields on your 10, 20, 30-year treasuries. Those are the ones that are moving around, more volatile than a penny stock or a meme stock in 2021. 10-year treasury yields were up almost 13 basis points today. It looks like here in extended hours, they're up another about 1.5 basis points. Tomorrow's data will be especially important because you're going to get the Michigan Consumer Sentiment Survey. Now, what's important here is your 5-year and your 1-year inflation expectations. Your 1-year inflation expectations look a lot worse than your 5-year. Here you have it. This is your chart of your 1-year inflation expectations. Notice what happened in October. Well, September, you were at 3.2%, 12-month inflation expectations. Then you jump to 4.2% in October. Does that go higher? I would say probably not, in my personal opinion. If it does, markets are not going to like that. Yields are probably going to go higher, and the markets might price in another hike from the Fed. Inflation is very much a concept in which if you expect inflation, you tend to get inflation. If you don't expect inflation, you don't tend to get inflation. It's simple as that. Really, if you wanted to boil down inflation, that's that. If you don't expect inflation and people don't expect inflation, then businesses, well, they're probably not going to raise prices. The products a business are using and the companies that are supplying that business with products probably are not going to raise their prices if they don't expect the business to also raise their prices. So throughout the entire chain of command, if you will, in the business world, inflation expectations feed inflation. Now, your 5-year inflation expectations are more important. This is the real wild card here because you were at 2.9% for a while in December, January, February, March of 2023, and then you started to go higher to 3% in April, then to May at 3.1%, and then you fell to 3%. Well, September of this year, you were at 2.8%. Then you jumped to 3% in October. Do you jump again for November? If you do, the markets, I will assure you, are not going to like that. If you stay at 3% or even fall, that's going to be great news. We're really not expecting a change all too much. And actually, I spoke too soon. Some people are expecting a change. Here we have it. Yeah, so, well, actually, no. We're expecting 3%. That's my apologies for your 5-year inflation expectations. But last time around, the forecast was 2.7% to actually fall again from 2.8% to 2.7%. You came in at 3% when your expectation was 2.7%. So last time, you were way higher than the expectation. Expectation is 3% this time around. If you come in higher and really above 3.1%, yeah, that's going to be a big problem for markets. Tonight, you're also going to have a lot of data coming out from the UK. It's highlighted in red like it's going to be a big volatility catalyst. I'm not convinced. I don't think markets are going to care at all what happens in the UK. But the ECB President Lagarde's speech at 7:30 in the morning tomorrow, Eastern Standard Time, could be important if they do kind of change up policy. Be on the lookout for that. It's not expected, but if it happens, that could move markets. Fed Logan speaks at 7:30 in the morning as well. Fed Bostic at 9 a.m. and then your Michigan Consumer Sentiment Survey at 10 a.m. So you're going to get some events tomorrow, but really 10 a.m. is the big one. Let's take a look at a couple notable charts on the broader markets, then we will go ahead and wrap up the video. So FX Evolution, this is a really good source for some charts on the broader markets. He does run a YouTube channel as well, FX Evolution. I do watch all of those videos just to stay up to date. I watch a lot of YouTube, and we're going to talk about that over this weekend when I kind of give you guys a backstory of my upbringing, why I'm into stocks, financial, bettering, I guess I would call it. Real estate, I own almost three rental properties now. It's been a hassle trying to close on this last one, but so far so good. That should close by the end of November. But I think these things are important to stay up to date with. If you're a Tesla stock investor, if you're an investor in multiple different companies, you're an index level investor, these things are important. Now, FX Evolution shared this. I'll go ahead and repost this. This is why you definitely want to go ahead and follow Michael Tyler on X. He says, since 1982, every bear market low that marked the beginning of a bull market witnessed small caps and equal weighted stocks outshining market cap weighted ones. However, this year has been a complete reversal, with lackluster returns from the market lows. It's been a notably narrow bull market that bears little resemblance to its predecessors. This will need to change soon. And there you can have it. It's been quite the opposite, right? Orange and yellow tends to outperform when you actually mark a bottom. And these are some of the great bottoms since the 80s. And that has not happened this time around. This is showing you this is a very unhealthy market. This is another great chart in which I will share to the X account now, showing the unemployment rate and some of your jobs reports when you tend to get a bottoming and actually, falling, which looks like we're there now, and then a rise, you almost always head into a recession, like literally every single time. So a little bit of recessionary fear could be portrayed in this chart. And central banks are now cutting rates around the world at the fastest pace since August of 2020. Similar trends have coincided with further acceleration of cuts around the world. And that's what you can see right here. It says central banks now cutting rates at the fastest pace since August 2020. This is from Bank of America Global Investment Strategy, posted on Bloomberg. And yeah, the monthly number of global central bank policy rate cuts, 3-month cumulative. And yeah, you're really starting to see some cuts here now. And you really get these spikes that coincide with periods of really weak economic activity, especially if you start to see big spikes like this. Well, that's a deep recession kind of scenario. And we're on that trajectory. Tesla stock currently is down 0.78% here in after hours at $208.32 per share. And like I did in the last video, I bought shares today. I plan on buying even more shares tomorrow. And, maybe it's 2 or 3 shares a day. Something along those lines. Whatever you can do if you're bullish on Tesla and you want more positioning, that's how you really want to play this. I do think Tesla, odds are, heads back down into the 190s, potentially even lower. The reason for this is, well, you've seen a very historic rally. The precedence is really good for this. Back in 2003 is the last time you've seen, I believe it's like 8 consecutive green days in a row. Well, the NASDAQ back in 2003 rallied about 68% following its 100-day low, in which that's what just happened to the NASDAQ as well. You hit a 100-day low, you proceeded to rally, I believe it's 8 or 9 green days in a row. I might have to double check that for us as well. But either way, you tend to have some really good returns over the next 12 months, but you're probably going to get a cooling down period as well. Maybe today was that period, the start. Maybe you trade sideways for a period of time. Maybe you trade downwards. It's hard to say, but odds are you see a little bit more weakness in our markets. And considering, who knows what in the world happened today with Tesla, it was a bearish day. And you probably get more bearishness heading into Tesla over the next couple of days. I will point out what I pointed out in one of the other videos. You have almost a textbook cup and handle formation on the longer term trend. This is dating back to December of 2021, January of 2022. This is your cup this as your handle, you do tend to have a handle that trends downwards, and then you get a breakout above this downtrending line of resistance, and that breakout can be big. So I'm still tactically bullish towards the end of this year. A lot of this next leg of the rally is really going to come down to the inflation report coming out next week. If that is softer than expectations, you are going to see what I think will be a face ripper rally. If you are short in this market, you will regret it if next week's inflation report comes in weaker than expectations. That's when I would expect Tesla stock could probably bottom out and get a solid rally going from there. So that is going to go ahead and conclude this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you guys want to support the channel, you can join to be a member here on YouTube and get your comments highlighted, different emojis, things of that nature. There's absolutely no benefit for doing that, but supporting the channel, and I greatly appreciate it. Makes these videos a little bit easier to do, a little bit more sustainable, things of that nature. But if you guys want to take it a step further, come trade with us live in real time. I think it's a great place to be. We're hitting some big trades over there. Sometimes we lose, but a lot of the trades lately have been some big winners. Come join us. Link down below in the description of this video. I will say I was wrong. I put my money where my mouth is. I did make like a $300 trade on Tesla. I think I lost like $120 so because I was wrong. I did expect a rally. As a lot of you guys said in the last video, I was 100% wrong. You can't, account for these off the wall situations and what could be just a false report in general from HSBC. Can't account for those things, but that's why it's all about risk management. So thank you for watching. My name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.